Good afternoon and welcome back to KW Property Management and Consulting's Community Association Best Practices monthly webinar. I will be your host, Tim O'Keefe, an Executive Director and Partner with KW Property Management and Consulting. Today, we will focus our discussion on the season that is upon us. That is budget season. Many associations have already created a final draft budget, while others are just getting their process started. Some haven't even thought about it yet, but in the next coming weeks, everyone will be fast and furious working on their budgets, I'm sure of that. Regardless of where you are in the process, you should get tremendous value from our discussion today. This month's webinar may well be my favorite topic. In the past, we've always gotten great comments, very favorable comments from our audience about the value that this budget discussion brings to them. And Lillian in Miami sent a note prior to our session today that said that she's on the finance committee of her property and her board president suggested this webinar to her and she's looking forward to it. So ladies who are going to be our experts today, let's not let Lillian down. Thanks to the state of Florida's legislature and the current inflation rate, we have plenty to talk about today. We received a number of questions from many of you before we got started, so we're going to do our very best to go through all those questions, and anybody who's got questions during this discussion, we will try to raise those too. So let's spend our time today discussing your budget process. We have two very knowledgeable and distinguished accountants joining us. Between these two ladies, they probably review well over 500 budgets a year. So let's get started, and I'll introduce our panelists. First, we have Malena Martinelli. Malena is a CPA and a director and CIRA co-practice leader for Stroemer and Company. Stroemer provides accounting, audit, tax, and financial management services for community associations. They have offices in Naples, Fort Myers, Tampa, Miami, Palm Beach, Orlando, and Jacksonville. Thank you for joining us today, Malena.
You're welcome.
And also rejoining me for this session this year is Roxana Dorigo. Roxana is an executive director and partner with KW Property Management. Roxana is a CPA, and she oversees our accounting services group within KW. Roxana is always kind enough to join me this time of year to provide updates and best practices for creating an association's budget. So welcome back, Roxana.
Thank you, Tim. It's one of my favorite topics. As you know.
I bet it is. We're sick individuals because we actually enjoy budgeting.
I actually enjoy budgets, and thank you all who joined us today.
Yeah, all those treasurers out there are saying, man, I love this time of year too. This is my best time of year. Living my best life right now. So we do have some poll questions that you all can see. Feel free to answer those questions. I'll share those results as we move through today's session. And if you have a question at the bottom of your screen, you'll see a Q&A icon. Feel free to click on that icon and ask your question. We'll do our very best to get things started and answer those questions for you. Roxana, let me start with you if you don't mind. So let's just talk a little bit about the process. Can you provide us best practices for a budget timeline for an association that has a December 31st year end?
Yes, so a little play on words, but budget your time. I think that is the biggest thing, not only every year that we try as a team here at KW, but also what's played really well for our associations to clearly address any market issues, effects on our business, on our associations. And, I know it's great to say, but we're already pretty much in the middle of our budget season, but there's a lot that's happening in our industry, as we all know, and we need time. We need time to address every single item. Last year, we addressed insurance, we addressed payroll, what was happening in staffing due to the market, and it took us time. It took us extra meetings. You need to call in those professionals, your insurance agents. Now the conversations went from one budget workshop to possibly 2 or 3. So we need time. We're already towards the end of completing a good draft for our associations. And believe it or not, even though we still have 2 months, we're always meeting those critical deadlines where we want to issue the budget for review by the middle of October. So as a best practice, it's better to have those budget workshops well in advance of the holidays So our goal is always to approve the budgets by November 1st. That will capture association owners, but also the board and their time invested in the budget process. The other best practice is to call the professionals like insurance agents and in writing have the potential increase for next year. And that, again, unfortunately, is part of what we are titling. When I gave this speech to our managers, we titled it The Perfect Storm, because we have not only still the market effects of low unemployment rates, competitive. We have to be very competitive in today's market to staff our associations for the level of service expected. So payroll's still on the table, just like last year. Insurance is still on the table like last year, but now add to it the Senate Bill 4D. Now reserves are on the table as well. So we start early, but it's because we do need information from outside parties, and we're gathering and also sharing and benchmarking against all of the associations in different regions. And really, it's to also address your financial condition. So we often forget that we're always focused on the P&L, the statement of income and expenses, but there's this other thing called the balance sheet. And really, we have to address the financial condition of every association. And probably this year's probably the most important year, because we need to get ready for all those condominiums that have to comply with the Senate Bill 4D. You have 2 years. You have 2 years to really align yourself with the statute, but also remedy some financial conditions that may be negative to the ultimate reserve contributions that have to be made. So my ultimate recommendations: budget your time, understand the balance sheet, take your time, divide and conquer, gather all of the data that you can, be ready to input your contracts. That's a very key part of your budget. Evaluate your condition as far as delinquencies, and then tally the results and be ready for November 1st, approving your budget.
Excellent. Thank you. I think we're going to spend a little bit of time today on that reserve issue and probably insurance again, because it seems like insurance continues to become an issue. I think that payroll is certainly an issue. It's less this year. Last year, I think we saw the big increase from coming out of the pandemic and trying to find people. And I mean, the reality is people are making $2 or $3 more an hour than they were just a couple of years ago. So that impact has been felt for the most part through a lot of the budgets. Some people are still catching up, but that was a significant impact last year on budgets. And so one of the poll questions is where some of your increases are coming from. So I'll be interested, as you all answer those questions, where you think your increases are coming from this year. Malena, what is the best advice you're giving to your clients right now as far as the timing and getting ahead of the budget season and some of the challenges that we have this year?
Right. So I share the same opinion that Roxana does, but building up on that. Besides starting early, reaching out to your vendors, I think it is a team effort to put a good budget together. You need to have your property manager in good discussions with your accountant and with your board of directors, because everybody brings a different knowledge into the budget process and different goals. Your accounting team is going to provide that expertise when it comes to the balance sheet, certain levels where they may think the association is appropriate to have reserve cash or your reserve components. The property manager has the knowledge of the day-to-day of the operations and the contact with the vendors, but then the goal has their own projects and list of items that they want to get through. And if all of them are not talking together, then the budget is not going to get association to that goal that they want, which is provide a good, nice place for the members to live and be at in order to be able to pay your vendors and go through all these projects that the association needs that are not regular maintenance.
Yes, that's so true. A team effort for sure. And that's why I really enjoy this process, because it's probably the only one where all of our departments at KW come together to help build this very important game plan for next year.
Right.
Because we all have our strengths, like you said. Accounting will give some information, can review numbers, can give you a feedback on how to address your financial condition. Your manager, obviously key player, needs to know the ins and outs of your association, what owners want to see in next year, obviously guided by the board and their decisions, but also recruiting, our payroll department, all coming together, our chief engineer department coming together to give us their opinions as well, and support the team. Ultimately, it's supporting the board, making difficult decisions. These 2 years have been difficult to make those decisions of increases.
So you were talking about this being a team effort. So I'm going to ask a question that Paul asked. Paul in Estero wants to know, in order to prevent having too many cooks in the kitchen, how many people should be involved in creating an annual budget for an association? It's not, they don't see the part that we're talking about, which is all the support internally inside our company, but from a board or the treasurer and the finance committee, like when does it become too many people, and is there a right number of people to get involved in this process?
That's a good question. I have both. I have boards that are being given very direct direction to the treasurer, and the treasurer leads the budget process along with the management company, and then it's presented to the board. But I also enjoy, and I think it really speaks to boards that have a finance committee. Yep. And the finance committee's responsibilities, the best ones I've seen, are very detailed responsibilities that include the budget, and how they play a role is that they're more into the details. They obviously want to get people in the community that have done budgets in the past, whether from an operational point of view or an accounting point of view, and can add value to all owners in this budget process. And they get involved to the details, and then they present it to the board along with our, us as a management company. I also enjoy that. So it does depend on owner volunteering for this task, because it is a little bit lengthy. It's 2 to 3 month involvement, I would say, and getting into the details of things. So I've seen it both ways. I can't say that there is a limit of number of people. I think really the focus should be on the process, making sure there's clear expectations and clear responsibilities, and a timeline. I think that's important, so that there are workshops built in where owners could come in and ask freely questions, and then that formal budget approval is already on the calendars.
Malena, do you have an opinion on how many people becomes too many people?
Right. So from the CPA point of view, we don't get as involved in the process. We come in more in the consulting side when associations don't have a good management company that can monitor this process, and they get in trouble. But what tends to be, you can have big groups that get a lot done and little groups that don't get anything done. It's like Roxana says, it's not how many people participate on the process, but how focused they are and how well they are working together. Sometimes you have 3 people and everybody comes in with a different goal, and everybody has their own opinion and cannot agree on anything, and you spend hours and hours arguing. So I think that is very important for the associations to make sure that as they start working on these processes, they make sure that it is an efficient one. And if they are deviating, they know when to stop and reorganize as needed.
Yeah, okay. If I could add to that for a second,
while you're adding that, I'm going to ask a question from Kathy, so you can just continue on. So Kathy in Miami Beach was also asking, in order to get the work done without interference, can the budget workshops be closed to general membership?
No, so that I'm glad that it aligns with what I wanted to say. The best budget workshops that I've attended, and it's been either a room full versus maybe one person in the audience, and multiple committee members. The best ones are the ones that set the rules at the beginning. They talk about when are they going to involve the owners that may be in presence, and then also the discussion points that are going to be covered. When we start talking about payroll and the board is present, obviously we have closed door meetings at that point, and we ask the owners to leave the room to commence a closed door meeting if we're addressing payroll. But it's the ones that set the tone at the beginning. First, it's the committee's time to get together and go through the budget for detail to come up with this final draft that will be presented to the board for their approval, and to lay out the deadlines, right, that we're trying to meet. It's also, I believe, our responsibility as a management company to kind of hone them back and kind of focus them on the task at hand, and that we are trying to meet a certain goal, produce a draft by X number of day, and we only have 15 or 30 days to do so. So I do believe that setting the rules up front, allowing owners to speak for the 3 minutes. So we try to follow those rules, even though it's not a formal budget, board meeting. We still try to follow the Robert rules of meeting.
Okay, excellent. And then Elizabeth was asking if you could expand on what balance sheet accounts should be focused on.
I'm talking about the fund balance and also your receivables. So,
and you're saying fund, F-U-N-D, not F-U-N balance, the F-U-N-D balance.
Not the fund balance, but the fund. So I mean, in normal terms for-profit organizations, a lot of people learn or like the term retain earnings. So in our world, in associations, it's fund accounting. So we call it the fund balance. And that's the accumulation from the beginning of time of your surplus or deficit that you may have at your association. So focusing on that balance is important to understand where does your association fit. Are they financially healthy? That gives me a lot of information in the fund balance. Also your delinquencies. Where are you right now? But then where are you going to be by the end of the year? Also projecting. And I look at receivables to see who has not been paying the association and who is in a legal process, because right there, that already tells me someone didn't pay for 2, possibly 3 months. They're going through a lengthy legal process that may take them through the end of the year. So it's going to either contribute or to a deficit or reduce your surplus. So the areas I look at are fund balance and delinquency, your receivables.
All right, and I'm looking at some of the answers to the poll questions today, and 63% of our participants have started their budget process and 35% have not. And of that group, 63% have budget workshops and 35% do not. So the numbers are exactly the same, basically the way they break out. So that gives you a general idea that most everyone is moving forward. It's still August. Some people feel like it's a bit early, but for us, it's a process. And so it's never too early to get started.
Sure.
Malena, if I could come to you with a question from Ellen in Palm Beach. She wants to know, how will this year's budget be different from prior years? You know, we've got new laws. Every year there's new laws that come into place. And so how is this year's budget going to be a little different than previous years?
So insurance, you guys have talked about insurance. It is something that we are seeing a lot. Associations did not properly budget for insurance, and the increase has been tremendous. So make sure that you reach out to your insurance agents. I know that I think they have some timing of how much before your policy comes due, they can give you the actual increase that you're gonna have. Then as a professional, they should be able to speak to you with regards to trends And that will give you an idea on what to account for, because they know what is being driven in the area that you live, the type of property that you have. So definitely reach out to your insurance agent, even if you think it may be too early. So that is one. Roxana was talking about bad debts. It is very important. We had some years where bad debt was not an issue because the economy was doing good and collections were in a pretty good place. But right now, with the economy shifting and talks about recession and all of that, there is an expectation that there may start to be some more delinquencies. So the associations really need to sit down with the property manager, the accountant, to make sure that they have a good handle on those units that are delinquents, the ones that are in collections. Because if you think that you're gonna be collecting from all these people assessments to pay for your expenses, but they are not paying you, then you really need to reserve. I mean, it's real dollars that we're talking about, even though it seems very technical when we talk about it, it's real dollars the association needs to pay for their services. And then we also have the question about the new law that talks about reserves. It is, we have 2 years to get this reserve estimate. It is an engineering study that needs to take place, but my understanding is there is not a lot of firms in the state of Florida that have the actual engineers with the licenses that can take care of this process. Therefore, you're gonna expect to have high costs with regards to these studies. It's not something that can be done like in the past. Associations had, they either would call vendors or have committees inside the associations taking care of the reserve estimates. This is not something that is going to be able to happen if you meet the requirements for the engineering study. Therefore, you want to make sure that you get these studies done early, because not only the cost is expected to be higher, but also the loss of supply and demand. If you wait until the very last minute and there is a big crunch and a big list for the engineering firm to get a lot of jobs done, they may charge you more. So you want to make sure that you are proactive with some of these processes, in addition to looking at your reserves and making sure that you are looking at the components that you have, the components that you may need, and start educating your members, because it's going to be a big shock to these associations, all these changes that are coming in for reserve funding.
A lot of the questions we got today are going to revolve around reserves, so we'll get to that topic. But
Okay.
I want to finish up on a couple of questions that both David and Patrick have basically asked the same question, Roxana, which is David's questions: what's a good ratio of funds to maintain in your operating account versus monthly expenses? And Patrick's asking the same question: is what's the rule of thumb regarding what is considered an adequate fund balance? He's heard 3 to 6 months of annual expenses. So what do we look at it from a management standpoint of those properties that are financially healthy? And so what do we consider that right ratio of income versus expenses to be financially healthy?
So as a rule of thumb, and from us as a management company recommending to our associations, 2 months of the average operating expenses. So I don't necessarily say, look at your maintenance fee for the year and divide it by 12 times 2. I actually look at the actuals and the projection. And then from those numbers, I look to see what are one-time items, maybe special projects or a leak that occurred that doesn't really occur every year. And I take those numbers out and then I average what truly it takes to run the association and take 2 months of that. And that is a healthy, what we consider stable association to have in your surplus.
That's the same thing we recommend, the 2 to 3 months of average operating expenses to go in order to have a healthy reserve or cushion, because we live in Florida and a hurricane could come in at any time. So when that happens and there is interruptions in services and people dealing with certain emergencies, the association needs to have quick access to cash. So it's good to have that cushion.
And Malena just gave you the answer to those owners that say, you have too much money, you give it back to the owners. We live in a hurricane-prone state.
Right.
You want to be the one with the money so that you could take care of your association. There are a lot of unexpected expenses that can come towards the association, and having those funds are going to make a difference.
Right.
And Roxana, Elliot's asking a question. This was something that came up, I think, about 2 years ago with radio frequency fire code compliance. And she's saying that associations need to set aside funds for radio frequency fire code compliance testing.
Yeah.
And any corrections if needed. Is that still correct?
Yes, they extended the deadline, pretty sure, towards the end of last year. So yes, that's still also on the table for those associations that have not taken care of it. That will be something that they need to. And I've also been asked, can I just take it from reserves? Well, unfortunately, no, because it wasn't a component already. The new component. So maybe the next time, but not this time. This time it has to come from operating or other sources.
Okay. And then can you talk a little bit about what happens for those properties that might have the good benefit of having a surplus and those that end up having deficits? So if you start with the surplus is taxable, and what can you do with surplus money to try to make it not taxable?
Yeah, that's a good one for both of us, because we've actually been many a time on meetings as to what do we do with this extra money. And definitely always a good recommendation, and probably even more so now, the association can choose to roll it into reserves, right? Like, would you agree, Malena? Like, of all options, that's probably the best option at this moment. When you have excess surplus, so anything above, let's say the three-month mark, to Malena's point, 2 to 3 months is comfortable. But when you go over that 3 months, you have to start thinking about giving it back to the owners in some way, and putting it into reserves and rolling it into reserves is always a good option. There's a revenue ruling that you can take part of, but it's very specific. And correct me if I'm wrong, Malena, because you and I have been on many calls, but you have to make the decision in the current year.
Right.
It has to be in a board meeting where you choose to have this revenue ruling and adopt it, where you're allowed to roll forward this surplus and to give it back to the owners in the following year.
Right. So it has to be a membership meeting, I believe, but that is where we focus on debits and credits. If it is a membership or I always want to make sure I ask the association's attorney, because they are the ones that interpret the law, and it covers your bases. You know that you are in compliance. But Roxana is correct. You can take, use that ruling and you roll the surplus into the following. The perfect way is to roll it into reserves. You don't really want to reduce your operating fees, because it's going to be really difficult in order to bring them back up in the following year. So we always work together with the association in order to make sure that it's done in the proper way. And it goes back to, it is a team effort where you need to have the property management company and the CPA working together in order to advise the association to have the best use of their funds.
Absolutely. We bring in the tax, experts to make sure also that we're doing it right and that it's conforming to what really the IRS will task us with.
Correct.
And then what happens if you're in a deficit situation? How do you build your way out of that?
Well, in the statute, the statute doesn't define surplus and doesn't define deficits. It doesn't tell you how to calculate it either. But it definitely says that during the budget, it needs to be discussed. Mm-hmm. Whether and clearly stated, whether you have a surplus, what are you going to do with that? And if you have a deficit, what is the remedy that the association is going to take? And again, there's nothing in the statute that says by next year, you need to be completely out of deficit. That doesn't exist. So logically looking at the things that are on the table this year for 2023 increases, we wouldn't say, let's recover the deficit all at once. we would be putting in place over, let's say, 2 years, maybe 3 years. There's also an option of a special assessment. I know that's not a great word for many, but there's different options how to address it. So the biggest way I communicate it is that as long as the board has a plan, and we help them with that, anytime any owner, goes to the DPPR and complains that they have a deficit and they're not doing anything about it, the DPPR is only going to ask, do you have a plan? And if we do, that's it. We've covered ourselves and we've done the best thing for the association.
So let me give you an example of a plan. So let's say, we'll talk about insurance a little bit more, but let's say your insurance happened to go up $100,000 this year, and you always pay for insurance out of your operating budget. Well, you can go get financing for insurance to help. You may not have that $100,000 check to write in May, but you can get financing for insurance so that you can pay it back over time, and then you still have cash available to you. So that would be a plan. That would be a viable plan that you could actually put into place.
Right.
Absolutely.
Right.
And-
You have that. I'm sorry, Roxana.
No, just to add to the lending, we're actually partnering with banks right now, talking about the financing, not only for insurance, obviously, but also for reserves. So reserves is also a big topic, and how reserves are increasing, and then obviously increasing the maintenance fees to owners, and how are we going to do that, right? Again, we only have 2 years to get us in line with the statute when most of our associations will have to comply. And financing is a great option, is to partner with banks and with the best terms for our owners.
The other thing I was going to mention is that the associations can always have a line of credit. It is something we always advise. It is relatively inexpensive for them to get the fee that they have to pay on an annual basis to keep the line of credit open. And it helps them pay for those operating expenses in times when they don't have enough cash, have some deficit. So that's also a great tool that the associations can use.
And as a service to our customers, a couple of years ago when the pandemic hit, that was one of the initiatives that we had, as we looked at the cash flow of each property to see if they had 2 months worth of operating income in the bank. If they didn't, then we recommended getting a line of credit, because the fear was that people weren't going to be able to make payments because of the pandemic, because they weren't going to be working. And it didn't really turn out that way too badly, but we had a number of properties that actually did get lines of credit. And now with what's going on with the increase of insurance and with inflation, those lines of credit are nice to have. You rather get a line of credit when you don't need it than when you absolutely need it, because then you already have the money.
Exactly. Well, and if the hurricane hits, we were talking about hurricanes, or for high rises that they happen to have so many emergencies and water leaks and all kinds of different issues all the time, the line of credit is right there, cash that you can use for that quick emergency. So it's
to that point, Malena, David's asking, do you recommend an insurance reserve to cover your insurance deductible?
A lot of associations do have that. So it doesn't hurt to have it. It is in the best financial position that you can be doing. If you can, and to build these reserves is not something that happens in one day. So if you can start working with your membership and educate them on the benefits of having these and start building it over time, do it. Yes, absolutely.
Yeah, we recommend it as well. It's one of the points that we ask our managers. Have you recommended having an insurance deductible as a reserve item? And something about that is that if you are pooling the insurance deductible line actually is calculated on a straight line. So it should be a component reserve, and the funds that go into the insurance deductible, because if you need it, it needs to be there. It can't be pooled. It's actually treated like a straight line item.
That's good.
Okay, so Roxana, one of the basic questions I know we've gotten from a few people is, what do you expect an increase? What are we seeing as a typical increase this year overall as in the budget from previous years?
Oh, wow.
A lot of times we say, well, it's going to be 2.5%, 3.5%. What are we seeing this year with insurance
That used to
jumping
be
up? Like,
Yeah, last year to this year was 12 to 15%. I'm seeing the same thing. Unfortunately, it's the same percentage range that we're seeing, and it's mainly due because of insurance. And there are, as earlier, Malena, you mentioned, you're going to have to lean on professionals, licensed engineer or architect for these studies. Also legal, because you're going to have to rely on your attorney to also navigate this law for your particular association. Yes, there's the law, but then there's you, particular association, and no association is created the same. In that regard,
So one of the poll questions that we ask is, do you expect an increase in your 2023 budget? And so here's how it broke down with the answers that we got is 2% are saying no increase at all. So I'd like to live in those properties. I think, maybe not, maybe I don't want to live there. 34% said it would be up to 10% of an increase. 51% are expecting 11 to 25%. So right there where you just talked about, Roxana, and then 13% expect greater than 26%. So that's how that number breaks down. So most everyone's expecting a reasonably sizable increase this year in their budgets. And then when we ask what's driving those increases, 4% said salaries. Usually salaries is going to be more than that, right, for the increases. Repairs and maintenance, 18%. Increase in insurance premiums, 54% of the respondents. And then funding reserves, only 15%, which surprises me a bit. And then just other was 8%.
Well, you know, that 15% on the reserves, it depends how you're reading the law. The law is giving you 2 years. So I think people just say, oh, that's 2 years. But what we're recommending is that you start now, because you do have the luxury of at least 2 years to bring the basis of your reserve contribution higher. And what do I mean by that is your reserve study, your pooling method creates a calculation, reserve contribution of 100,000. And what we're going to be recommending is put another maybe 5 to 10% on top of that, because there are components that the statute, this new law talks about that doesn't even exist in any, I've seen it maybe once in a reserve study, like the foundation, the flooring, and they're not talking about the carpet on top, they're talking about the subflooring, the structure, electrical, and the same thing, it's not the lights, it's the infrastructure. Those components don't exist. They're going to exist in 2 years. So might as well start increasing that reserve contribution, making your owners little by little used to a different basis in reserves. These reserves are not going to be able to be waived or partially funded. So that means we all have to contribute to it. The calculation, what does it mean? There's still a lot of clarity that has to happen as to what's going to be, how are you going to calculate foundation, for example. And things like that, but we have to start getting ready. So I think everyone should increase reserves next year.
The last question from the poll was, do you have a plan to fully fund reserves by December 31st, 2024? And 65% have said yes, and 35% have said no. So I think we'll spend the next 15 minutes or so talking about reserves and what that actually means. And I will preface this conversation with, none of us are lawyers here. I did stay in a Holiday Inn Express last night, so I will play lawyer and tell you what I think this all means. But no, we're not the lawyers, but we've gotten this question 2 or 3 times already, which is a building less than 3 stories affected by this? My understanding is no, it's not. It's condominiums 3 stories and taller are affected by this new law that has gone out. So hopefully that answers your question, Kathy, that you had asked. And the point that Roxana brought up a minute ago, there's been a lot of debate, a lot of articles I've read about what's it really mean to fully fund for load-bearing walls, floors, and foundation. Because look, if you've got to replace load-bearing walls, floors, and foundation, you pretty much have to move out and start over. And that never was contemplated. So I think when this legislature comes back into session at the end of the year, they're going to have to clean up some of this stuff that's just created more questions because, there's not going to be enough engineers to go around and get these engineering studies done. The reserve studies, a lot of the engineers don't want to do them yet because they don't understand what the law is actually requiring, because they know it makes no sense to include load-bearing walls and foundations. But, those are things that have to get addressed at some point in time.
What I've seen, just one reserve study that I can remember, is that they had an allowance for structural recertification in the reserves. And I thought about that as this law came out, and I said, maybe that's how they're going to address it, by putting in a number as an allowance towards these items, but every year. So the way the reserve study that I saw many years ago, it wasn't even a new one, is that they put in an allowance, let's just say 100,000 every year. And I kind of see that a potential for how they're going to address and clarify the bill.
Malena, let me ask you this question that came in from Hazen. I'm going to go backward, then we'll just go forward on reserves. But Hazen's asking, can you carry over or carry back operating surpluses or deficits to break even over the long term? We talked about you really need to make decision in year. So can you, play the years out and try to break even over the long term?
So, and that's more of a tax question, and I am not a tax expert. I know that you can carry, and this is based on several meetings that I've had with clients that are involved in tax questions. The surplus, you can only carry it over 1 year. The losses, I think, is what you can carry back indefinitely. But if we get the email from this person, I will be more than happy to follow up with the tax director in the firm and get them the answer. I think that's the more accurate way to answer her question.
Okay. And then Joan, I know you're asking for a company that actually qualifies as a structural integrity reserve study company. We can give that to you. So feel free to reach out directly to me and I can give you a name of somebody. Let's talk a little bit about reserves. Roxana, do you want to talk about what the law is now requiring by December 2024?
Sure. So there are, you could kind of break it down, and I did a matrix mainly for myself, but I think we're going to use it as a tool, is that I had to read the law really in detail, the actual raw law, and break it down into 3 components. One is actually due January 1st, 2023. So if you are a condominium under Section 718, you have to go to the DPPR. We have a link, so we're happy to share with all of you the link to a quick questionnaire that has to be completed if you are a 718 condominium, 3 stories or higher. So if that is your association, you must log into this link. And basically, it's very quick. I think it'll take less than a minute, and you let them know if you do have 3 buildings, what counties do they reside in, etc. So that's one. The second is the milestone inspection, and it's a 2-phase inspection, as I understood it. It's phase 1 is a visual inspection. Again, if you are a 718 condominium, 719 cooperative, with 3 stories or higher, you would have to comply with this law. And also the age of your building, if you're 25 years or older, or 30 years and older. So you have to, do a phase 1 visual inspection, where by a licensed architect engineer, where the report will just basically, by them walking your property, identify if there's anything that they are concerned with as it relates to structural integrity. If they do, and they give you a report that they do see certain areas, then phase 2, which is a more invasive inspection, has to happen. And that's where they start chipping at the walls, as I've seen it in some properties that are going through recertification. And then they'll provide a lengthier report as to what has to be fixed. And then the associations will have, from that point, 365 days to amend those issues in the building related to structural integrity. Our associations, as many probably associations of the attendees have received written notice already. So the minute the law passed, there were letters issued by your counties, by your building departments about whether or not you needed to start doing that milestone in visual inspection. So the other is the structural integrity reserve study. And that's where it outlines certain components that will be required of the same type of associations, 718, 719, three-story.
Roxana, let me jump in and just talk about what the components are. So
Sure.
we talked about load-bearing walls, floors, and foundations, but there's 8 other areas. There's roofs, there's fireproofing and fire protection, there's plumbing, electrical systems, waterproofing, exterior paint, windows, and components that are greater than $10,000 that affect these systems.
And that affect there. So that's like open-ended, right?
Yeah, exactly. That's like, we can't think of everything, so we're going to add that.
So what
D, all of the above.
Yeah, something we were doing is aligning ourselves with the presentation of the reserve schedules are going out in the mail out to the owners when we are ready to approve a budget. We're going to have subsections, structural components, aligning ourselves with those, that statute specific to those components. So I did the practice through a few of our associations, and yes, I could find the roof, I could find waterproofing and exterior paint, I could find the waterproofing, I could find just those 3 categories. I mean, the rest don't exist in the reserve studies right now, like the foundation, the flooring, electrical, plumbing. I mean, plumbing, I came into the industry in 2008 when there were a lot of conversions from apartments to condominiums. And at that point, and still exists, but it's not so prevalent, is that there are converter reserves. I don't know if you remember, Malena, but there were converter reserves, and one of the required ones were plumbing, but that's not something common to see in reserve studies.
Right.
And so, Malena, Kathy's asking a question. Do you think straight line or pooled reserves are better? And that's kind of more of a global question, but what is the law stating around which pool, can you pool or straight line reserve for these structural reserve study?
Right. So with the new structural items, you cannot waive, you cannot reduce funding. Therefore, and you cannot use the funds for anything other than that component. Therefore, these look to me like a straight line.
Yeah, to me too. Yeah.
Yeah, you may have a pooling method for everything else that you had there already, but then these new structural items are going to be a straight line components. Now, the question is, what about the funds that I already have in my reserves for some of these items that are already there? So that's where I say, get together with your professionals, with your attorneys that can advise you legally if you can move the funds from what is already being reserved in these components into the new structural ones. And you may also need to get help from whoever. If you were under the straight line method already, it will be easy because you already have the dollars there. But if you were under the pooling method, it's a little more complicated because the way that the reserve study companies make those calculations is a little bit more involved. So you may have to get back to your professionals, involve the CPA, whoever did your reserve study to help you extrapolate those dollar amounts if you are able to do that.
Yeah.
Okay, so I'm going to ask you guys the the $10 million question here, which is, what does it actually mean to be fully funded? That was a question that was asked on the chat line, and there's been a lot of debate about what fully funding means, because some will tell you that load-bearing walls, floors, and foundations are not to be considered in this calculation, and therefore not fully funding, does not provide funding for load-bearing walls and floors. I've read about that, but there's going to be a lot of cleanup. The legislature is going to have to straighten some things out. But as you understand it today, how would you define fully funded?
Well, I think it's fully funded reserve calculation maybe might be clarifying when calculating under the pooling method, and it's not a free-for-all like some people may think that there is actually a structure and requirements in the statute to properly calculate reserves under the pooling method. One of which you can never go to zero. And you should build in some inflation into the numbers, the projections. And there should be a number that you come up with in this calculation. It's the same across every year at the point where you never go to zero. So there is some rules. And so when the calculation is done, it's called fully funded reserve, because it's the calculation that is by statute, as long as it's been calculated, that's what's fully funded reserves. But
How do you get to that
there's a little bit
calculation?
of I'm sorry?
How do you get to that calculation?
So basically we take about 30 years. It's up to the longest remaining life of any one component. Typically it's about 30 years, 30 to 40 years. And you basically, if you could think of it as a grid, on one side, you have all your components, the detail behind all of your capital assets, all of your, either the roof, if you have two different types of roofs, it should be itemized, the replacement cost, the actual useful life of each component, and then the remaining life. And all of this comes from a reserve study. So we do rely on those reserve studies to get that, especially in pooling. And then you see this grid over a 40-year term. And in every year, you're looking to see what is the next component that needs to be addressed in what year and what is the amount. And that amount should increase over time by at least inflation. And so then you look at a bottom and you say, for every year, what do I need to be able to pay for the reserve components that are up next to be replaced? And then you look at your cash. So what do you project to have in reserves? So now we need to make sure that we have enough in that cash, that pool, for those expenditures every year from now to 40 years. On the straight line method, it's a little different. It's a calculation. So if there's a roof of $120,000 and you have 10 years left to that roof, you need to make sure you have that 120,000 in year 10. So you basically, if you started from zero, you would divide the 120,000 divided by 10. So you're funding about 12,000 for the next 12 years, or excuse me, 10 years, to have that money there ready when your roof is ready to be replaced. So it's very different calculations. The pooling method has been the preferred method. I think, Malena, you probably seen, as I have, in the last 3 to 4 years, most of our associations on pooling, which I think, now we have these structural components that sound more like a straight line. And I think that's the clarity that has to come from the Senate, the building commission.
Right. The belief today is that those structural reserves need to be straight line reserves, but that some people will interpret it how they want. So I think that will probably get cleared up next session that we have. And then did you want to add anything to that, Malena?
No, we as CPAs are not as involved with the calculations as Roxana is. We look at them, but I agree with her. The straight line is very simple. Pooling is a little more involved, but typically whatever they recommend that is gonna be fully funding based on those calculations, then it would be considered that you're fully funding. Some associations in the past, because they had the ability to reduce the funding of the reserves, they took the decisions of funding 75% or 50%. That may not be the case anymore. And that's where all that education to your members comes into play, and starting raising those fees steadily so that they get used. It's not a big shock right away. The small increases little by little will make it easier.
So one of the big changes, we're talking about changes. One of the big changes throughout the state of Florida is the fact that you do have to have that milestone inspection done at year 25. In the past, that was really only a requirement in Broward and Miami-Dade County. The rest of the counties throughout Florida didn't have that requirement. Now all the counties require it. So Miami-Dade and Broward, they're not feeling the effect of that. Used to be 30 years, but now it's moved to 25. So not a big change for those two counties. And then also, correct me if I'm wrong, if you're within 3 miles of open water, somebody asked the question, Kathy asked, or somebody asked the question, does that include if you're on a river? I don't know the answer to that. If river's water, but I think the reality is it's the salt air that deteriorates the property. So maybe this legislature will clean that up a bit. But if you're on water, which a river would be water, then I'd say yes, you fall under that requirement today.
Yeah, the intercoastal, that was a question. We have some associations along the intercoastal. They did get a legal opinion that they do have to comply.
Yes. Okay, so we've got about 5 minutes to go, and I have a whole bunch of questions that we got in advance. If I could kind of rapid fire through these questions, if y'all don't mind giving me answers to them, that would be fantastic. We talked about a lot of these issues that have already come up. Frank and Dania Beach was asking that we have 40-year inspection done in 2019. Do we need a new one for the 25-year required inspection?
Yeah, that is a good question. I think that's part of the clarity that we need. I have not gotten an answer to that from legal parties, but I'm definitely seeking the answer to that question.
Lynn in Naples is asking a good question, and Malena, maybe you can address this. What inflation rate is reasonable in your reserve plan?
Well, in the past, we were always seeing 2%. I can tell you based off only certain clients that are undergoing major projects in the past year, between the higher cost for materials and the higher cost of labor, they are having contingency and having to fund additional 20 to 25%. And this is people that are undergoing those big projects right now.
Okay, very good. Anne in Palm Harbor wants to know, can we have a one-time assessment to bring reserves to be fully funded or increase maintenance fees?
Yes, you can. And I'm seeing that more often now.
So you're seeing reserves being fully funded through maintenance fee increases or from a special assessment?
Special assessment. And in order to put that into your calculation for fully funded, you must have passed the special assessment already when you're about to pass the budget with the line that says you have a special assessment that will help you bring you up to fully funded. I hope that makes sense. But if you're counting on that money to be able to go to your owners and say, we're getting your money in a different way to based on the calculation of the reserve study, we're having it through the special assessment, then you can issue a budget with fully funded because you already have that special assessment money coming in because it's been approved and already being funded.
Okay. I'll take this question from Daniel in St. Pete, who's asking, when will the state of Florida require board members to become state certified rather than just signing a ridiculous piece of paper that said they read the state statute? There actually is a law today that you've got 90 days either before getting on the board or before getting on the board or after getting on the board. You have a 90-day window to be certified. And I would suggest that all board members take advantage every time they can of the attorneys that put out the board certification classes. You only need to get the certification one time while you're an active board member, but take that class 2 or 3 or 10 times. You learn something every time you take it based on the attorney that's giving it. So it's not a bad thing. They're free. They're all done virtually. It's a very easy thing to do. I'm happy to give you some names of the law firms you could look at if you want. Feel free to email me and I'll give you names of law firms who regularly hold these kind of sessions. We typically do a couple a year as well. So that's the answer to that. Fran in Deerfield Beach wants to know, said that they are using the straight line method for their reserves and they were fully funded. Should we go to pooled method for 2023? I think the answer is probably no, that you might be required to be straight line for the structural reserves. Roxana, Anastasia in West Palm Beach is asking, she's saying that they're a 55 and older community. Is there a maximum percentage the board can raise the budget for operation expenses and reserves?
No, but I get asked at least a couple of times during the budget season. We can, or it's more like a statement. We can't raise our budget more than 15%. I said, but why not? And it's because the statute says so. And I'm like, no, what the statute says is that if you do raise your fees over 15% year over year, and you take reserves out of that calculation actually, and one-time special projects. So once you take that away and you still have 15% higher in maintenance fees for next year, all you're doing is opening up a window 21 days after the budget has been approved by the board for owners to get together and put together what is called a substitute budget. It's an alternative budget that they feel is more equitable for themselves, for their financial condition, and then they present it to their board, and the board should consider it, but they still can approve the original budget that ran higher than 15%. So really you have to do whatever is needed for your association. There's a lot of things here, what we're calling here at KW, the perfect storm year. And, 15% may be the average that we're seeing across the board next year anyway.
So let me tack on this question to that, because Renee in Fort Lauderdale is asking kind of a similar question, saying, what's the best way to prepare your board and owners for increases? So you're going to have this 12% or 20% increase in your budget. What's the best way to let them know that in advance so they can prepare for it?
Well, I think it's time. And that's why we also think November 1st is a good time, because it gives people about 2 months to adjust their financial condition. Everyone's different, you don't know, and we want to make sure that you have those budget workshops. I think it's time and allowing for those open sessions where they're free to ask questions under a guided, meeting. And I think there are going to be a lot of questions, right? This is the second year they're seeing potentially double-digit increases, and we're here to serve the association, all owners. And I think budget workshops and just being mindful to approve your budget with enough time, giving someone a chance to really see how they're going to adjust financially.
Okay, and I know we may have talked about this, but y'all may clarify the question a bit for me. This will be our last question, and then I'll come to you. One more thing. Kirk in Bonita Springs is asking, he said, our reserve study is both basis cost and future cost amounts. Under generally accepted accounting principles, are we required to use future cost amounts, or can we choose? So I'm not sure I understand the question. So from an accounting standpoint, can you rephrase the question to me?
I don't think GAAP guides that. Really it's the future costs, because it's about the replacement cost when you're going to replace it 10 years from now. That needs to be part of the calculation, whether it's your straight line or if you're doing particularly the pooling method. It's that future cost that has to be used. But that's really rules under the statute and the two different methods, not necessarily GAAP.
Correct.
Final question for both you ladies. I'll start with you, Malena. What's the best advice you can give a board this year as they prepare and approve their 2023 budget?
Be proactive and communicate between all of the different professionals that you have helping you on the association. So that's really what encompasses everything.
Okay, very good.
Reserve.
Right.
Yeah. Well, and it is really understand where you are with reserves and understand what it means to become fully funded, because and also don't be intimidated by it. Don't be afraid to get a loan. Like, there's going to be a lot of banking activity and over the next 18 months or 2 years, because it's going to be hard to come up with, in some cases, 5 or $25 million for some properties that may not have properly funded for reserves over the years. So there's going to be a big number that's going to have to be set aside, and maybe a loan is going to be the only way to be able to reasonably get there. So, talk to your attorneys, work with your accountants, and your management company should be able to help you find the banks that are offering the most favorable rates, and work with a bank that understands association business. Don't go to a retail bank. The retail banks don't understand our business, and you won't get favorable rates. So that would be my best advice I could give when you start to get fully funded, is understand what that amount is, and then go to the right place to get the funding. You might be able to fund it internally. You might have done a great job of keeping up with your reserves over the years, and I hope that's the case. But what we typically see is a lot of properties have a tendency not to fund properly, and now they're going to have to get caught up.
Yeah, agreed.
Okay. Well, any other closing comments that either one of you ladies has today?
Well, I do like the budget season, and it's really because it highlights our team. Like Malena said, it's a team effort, and it is going to be a tough year again. I'm not going to sugarcoat it, but it's about really having time and start. If you don't have it on your calendars now, start measuring your calendars for those budget workshops, and with the end goal of approving, if not by November 1st, sometime before Thanksgiving, so everybody has a chance to adjust for next year.
And when we come back next year and have the same conversation, hopefully when we ask that poll question about how you're doing on funding reserves, we're going to see a lot more people say that they're in pretty good shape when it comes to funding reserves. So at least you're going to be well on your way. We had a great session today. We talked a lot about budget season. Some people love spring, some love the coming of summer, some love Christmas. We love budget season. So here we are in the middle of budget season, and we're moving fast and furious to get all of our customers taken care of. I want to sincerely thank all of you that joined us today's seminar. Special thanks to our panelists, Malena Martinelli, the director and CIRA co-practice leader for Stroemer and Company, and Roxana Dorigo, my partner and executive director for KW. Thank you. You're both terrific today. Good luck to all of our board members as you prepare your 2023 budgets. Be sure to rely on your management team as you create your budgets. There are professionals out there that can help you. Don't do this on your own. Today's session is recorded. You can watch this broadcast again if you so desire, or share it with a fellow board member that you think could benefit from it. You can find it on our website at kwpmc.com and our YouTube channel, which is KWPM TV. Thank you all. We will do this again next month. The third Wednesday of every month is when we typically do it. I was on vacation last week, so I did it today instead. Thank you all so much. In closing, I only ask you to stay healthy, be kind to your neighbors, and get your budgets done on time. Thank you all, and have a wonderful afternoon.
Thank you, Tim.
Thank you.
Bye-bye. Bye, Malena.